Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The headline earlier was South Korea declares martial law. However, lawmakers have now voted to request the lifting of the martial law. The president says that martial law, though, is necessary because of political deadlock over the budget. It's confusing. It's moving the FX market. We want to get more for you. Joining us now is Daniel Ten-Kate. Joining us, he's Asia EcoGov executive editor, economic government executive editor. Hey, Dan, can you just help us understand the last 12 hours?
Yeah, I mean, we're still trying to figure it out. But essentially, the president kind of stunned the nation with this late-night power grab where he declared martial law for the first time in decades. And Korea has a long history of that. And essentially banned all political activity, banned parliament, et cetera, claiming there were North Korea sympathizers that he had to take down. In reality, he lost the parliament election in April, and ever since then he hasn't had a majority in parliament. And the opposition party is doing what opposition parties do around the world, which is, try and block his initiatives and push their own initiatives through. So he's had a bit of divided government there. It sort of came to a head with a vote on the budget. They were demanding different things, and then he just pulled this move, which even his own party is condemning at the moment. So you had opposition lawmakers race to Parliament. They voted to ask him to withdraw the request for martial law. According to the Constitution, that means he must comply with the request. There is some legal ambiguity now that they're trying to work through. We haven't heard from him since Parliament voted, so we're not sure if he'll comply. But people are coming on the streets. There was some clashes with police. Overall, fairly calm on the streets that we could see right now.
Right.
But the big question now is whether he'll comply and drop this whole thing.
I have to ask the question, Daniel, but who has the support of the armed forces of South Korea?
Well, that's a big question right now. It's unclear if the army is going to back him to the extent, if you get mass protests, are they going to, start shooting in the streets or something like that? I mean, that's a big question. And we've seen in Asia a couple other places where the army has refused to do that this year. Bangladesh, in particular, was one. It doesn't appear like it's coming to that yet, although we'll have to see what the next few hours and days bring. But that's an open question at the moment.
So I guess, okay, let's just pretend that the president says, okay, you guys are repealing martial law, fine. Then what happens? Because we're still clearly at a standstill, and clearly this is a big negotiating tactic that the president was using to get his agenda passed. So then what happens? If the government is in paralysis, what gives?
Well, I mean, they were negotiating a budget, so his view of paralysis and what's actually taking place on the ground are two different things. It looks, there's already people calling for him to be impeached after this. His own ruling party is condemning his move. He's very unpopular anyway. So, it's very likely we could see support for him plummet, and he could be impeached and thrown out of office that way. That looks the way it's going, unless the army were to back him and he were to kind of bend the Constitution, which, so far we haven't seen, but we're perilously on the brink of that.
Oh, my gosh.
All right, Daniel, thank you so much for your reporting. Really appreciate it. Daniel Ten-Kate, he is Asia Economic and Government Executive Editor for Bloomberg News. He is based in Hong Kong. For those of you that have a terminal, Top Go, and you kind of get to T Live, and boy, this Top Live blog is that's where we're getting all information, real up-to-date information from reporters on the ground in that part of the world here. So we will certainly keep you up to date on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get the market then take here with Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Nancy, I keep reading about how there's so much money in stocks. We're still in a U.S. exceptionalism kind of situation, but no one wants to pull the trigger and sell and go somewhere else. What are you guys doing?
Yeah, well, we still like the U.S. best house on the block in terms of earnings growth, in terms of productivity, in terms of technological innovation. And the valuations, despite all the hand-wringing, are not super out of line. I mean, look at the equal weighted PE is 18 times forward earnings. Historically, it's averaged 17.5. So we keep going back to our analogy, which we've been talking about for almost 2 years, which is this market, this economy is analogous to the 1990s. And we see so many similarities. I mean, no analogy is perfect, right? But we see so many analogies that line up. And that was a time when you had, an inverted yield curve, a labor shortage, geopolitical tension, a number of the things that we have today, as well as high interest rates. 10-year was between 5 and 8%. Fed funds rate above 5%, yet you had robust stock returns coexisting with that. So we still think you want to be long this market for some time. And, Europe has dramatically underperformed. The rest of the world has dramatically underperformed for the last 20 years. And I think a lot of that has to do with technology.
So what is your technology call here these days?
We still like it. I mean, I think the Mag 7 is the Mag 7, but we are still exposed to the chip sector, and we had been shifting to software. So we still like a number of those names. Largest holding reports tomorrow, which is Oracle, but we own ServiceNow, Microsoft, we own some Adobe. So we're in the space, and we think that continues to be where you want to be.
What do you do with the super popular AI plays, like an NVIDIA? If you didn't own it, well, actually, do you own it? And if you didn't own it, what would you do? Okay. Would you add, or do you just kind of put it in there and say, all right, you're good, I'm going to go look elsewhere?
It's such a great question, because if you're trained like I was as a value investor, you're always waiting for the pullback. But if you go back and look at Amazon, for example, since the IPO in May of '97, May 15th, it's up 270,000%. So when was it too late to get involved with Amazon? We added NVIDIA in the summer during the summer tech swoon, so we missed a big chunk of it. But I think, like Tesla, these are stocks that are driving innovation. You can go back and look at Walmart. That stock outperformed for many, many years. And so I think this, again, is where you want to be. We owned and still own the poor man's NVIDIA, which is Broadcom, in our 12 best ideas portfolio, along with ServiceNow, Microsoft, and some of the names I already mentioned.
You mentioned the chip space. How about Intel in the news with Mr. Gelsinger? We now, Bloomberg reporting that he was forced out by the board here. What's your take on Intel? Because we all grew up with Intel as being a leader. Now, obviously, they are not. Can they get that mojo back at all, do you think?
Paul, I'm not optimistic. Okay. I think go back to Xerox, who developed the mouse but did not commercialize it. So Microsoft and Apple commercialized it, and then they lost their innovative edge. I think Intel is so far behind at this point. We sold it about 3 years ago because it was clear to me that he didn't have the leadership chops to turn the thing around. Instead, he went to Washington with his hat in hand and got, attempted to get money, which he did. But now you've got to deliver, and the foundry business is losing money, but the money from Washington is contingent on having a foundry business. It wasn't just Pat. Bob Swan ran the company sort of as a placeholder for a couple, 3 years. And there was a time when we used to joke that AMD existed simply to ensure that Microsoft didn't have a monopoly, and look how that has shifted with the right leadership. So I think in a bull market, there are much better places to be, and you're not even getting paid to wait via the dividend any longer.
So that's sort of your call on tech. You mentioned Walmart a couple times. What other stocks are on your radar right now?
We like a lot. We're overweight industrials and consumer discretionary, and our theme is old economy companies that have pivoted to the right technologies. So in in industrials, think of Quanta Services, which is PWR, and Emerson Electric. Those are names that we own, along with a number of the defense names. But that's where we're focused in that space. In consumer discretionary, we like, some of the usual suspects, but included in that is Home Depot and Chipotle, which are both in our 12 Best Ideas portfolio, as well as Amazon, which is in our 12 Best Ideas portfolio.
Did you guys change your investment outlook approach the day after the election last month? Did anything change?
No, we anticipated, as much as you could. And, I always tell our clients, because we've got on both sides of the spectrum, right? Don't invest your politics. Buy great companies that you can own for a lifetime. So we'd been kind of shifting in the summer, during the second summer tech swoon in a 2 years in a row, and then broadening out over the last year. And I think, we run a clean energy infrastructure strategy, but we hedge it with oil. So I think there's a, it's a little cynical, but you need that bridge. And so I think there are a lot of ways to make money no matter who's in office. And so that's been our focus.
For consumer discretionary in particular, do tariffs raise your eyebrows at all?
I think, Alex, I think it's mostly rhetoric. I know that he uses this as a negotiating tactic. We know that from last administration. Could it be problematic? I think the costs just get passed along to the consumer, so that has its own implications for inflation. But I just don't see this president is president-elect is so focused on the markets. I don't think there are going to be policies that are designed to cause problems for U.S. companies. So that's speculation.
Folks on the East Coast, this is what some folks on the East Coast do. They winter in Florida, and they summer, in the Hamptons or something like that, or north. If you're on the West, you summer Lake Tahoe and winter in Lake Scottsdale. That's how it's done out there.
Kind of, yeah. Kind of like
But doesn't
that.
it get cold in Scottsdale?
Yeah,
No.
it does. A little bit.
But what does cold mean?
It doesn't mean this.
Yeah,
it means, it's 45 degrees outside. I better put on another down jacket over my down vest. Because
you're like 15 minutes.
You're wrecked for every other climate once you live in Scottsdale.
Yeah, but you have Scottsdale, isn't it? Like, you start out the morning and it's 30 degrees, and then it gets to be 80, and then it goes back to 50. I can't. It's too much. As a woman, you already carry a big purse and it's heavy, and now you got to carry layers.
Layers. That's what it's all about.
It's too hard.
All right, Nancy, thank you so much for
Thanks,
joining
guys.
us here in our studio. Nancy Tengler, she's the CEO and Chief Investment Officer, Laffer Tengler Investments. Again, coming in from the West to bring us some of her thoughts.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now in studio is Sarah Samuels, Head of Investment Manager Research over at NEPC. She's a partner over there and oversees the firm's 45-person investment manager selection team across private equity, private debt, private real estate, real assets, hedge funds, and public markets. Sarah, it's great to have you in studio. Thank you for joining us.
Thank you very much. It's a pleasure to see you again.
You too. So let's leave public markets aside for a sec, because we
Okay.
get plenty of guys with their calls, blah, blah, blah. Let's talk about the private market.
Yes.
What do you think is what the hot spots are going to be for next year?
Well, just to set the stage for what's on limited partners' minds, institutional investors' minds today, they're really not seeing the distribution activity that they typically have. So distribution to paid-in capital is not coming back at the pace that they had modeled out. And what that means is that there are fewer dollars to commit to future funds, because it's an equation, it's a closed-loop system, there isn't unlimited capital. And so we're really hoping that we see deal activity and distributions and transaction activity begin to pick up in 2025. And I think that it will. We are seeing lower interest rates, which helps with the deal economics. We are seeing better valuations, and we may see some stimulative policy.
And it looks like I guess just maybe from a tax perspective, there may be some easier tax treatment for some of these gains that some of the limited partners have. Do you expect this new administration to foster more deal flow? We have seen some reporting on that. Do you guys, from your perspective, expect to see increased deal flow, whether it's IPOs, whether it's
M&A, bolt-ons.
Yes, so there are a number of ways that these things can happen, that these deals can actually be executed. There's obviously the IPO market, which is open today, but not being tapped broadly because buyers and sellers are not meeting in the middle on price. There are strategic investments, so selling to corporations, and we are still seeing a lot of that. And then there's sponsor to sponsor, which is a private markets firm buying something from another private markets firm. And so if we see more favorable tax treatment, if we see lower interest rates, more easy antitrust stances, as well as regulatory easing, then I think that it could be quite a bit easier for smaller companies in particular to either go public or to grow their earnings.
So typically when I talk to someone in private equity, they're like, oh, well, it's a vintage, so it's a long term, right? So you're going to give us money now. You don't get it back for 10 years. Like, it's fine. Like, everything will sort itself out in 10 years. And then we get to today, and then I want my money back. It's been 10 years, and it's hard to get that cash back. Does that interrupt the popularity of private equity or even a private credit at this point, or are these things that are just managed?
It's a great question. There's a lot to it. So it doesn't interrupt the popularity because there is still a pretty meaningful premium for private market investments over public markets. And public markets alone are not going to get institutions to where they need to be. Many institutions have an expected return of 6, 7, 8% nominal. And we're expecting, mid-single digit returns for U.S. equities, for example, over the next 10 years. Whereas in the private markets, we're expecting double-digit returns.
But double-digit, like 10, 11, 12%, or like more than that?
Depends on the area. So for
okay.
something like private debt, and there are a variety of different flavors in there. There's subordinated capital. There's, direct lending, which is a lower returning asset today. There's a lot of capital in there. There's distress, and then there's opportunistic, which we're really excited about. And that's a catch-all term for really creative financing solutions. So that's either providing liquidity. So being a liquidity provider is what we are most excited about, both in this year, in 2024, and next year. That could be providing creative financing solutions for GPs to get capital back to LPs. It could be being a lender to real estate, with real estate debt, through private debt, or by investing in secondaries and providing liquidity to GPs and LPs alike.
Are you surprised we haven't had more IPO activity in 2024? I mean, the S&P's up 25%. I mean, back in the day, I would have been ripping companies out of into the marketplaces. I mean, right. We get a 10% move in the market, we're on the phone straight for 36 hours calling everybody.
So IPO activity has honestly not historically been the lion's share of exits.
Yep.
So, but it is very important, and it is open. So I think it's really interesting that we haven't seen more companies price and go public. Many cases, especially in venture capital, the last round financing is the valuation methodology that is used. And that last round of financing won't reset until they price another round. And so we are seeing lots of companies that are held at valuations that are not actually reasonable, and there will need to be a reckoning.
Where in, say, private credit is the most interesting? And how do you look at it? Is it like industry-based? Is it like, how do you break it down into buckets?
Yep. So we are looking at things like distressed debt, which is really looking to take advantage of truly
the type of financing,
situations.
not necessarily like sector-based or anything along those lines.
Well, and then we're also, pretty interested in asset-backed lending, so ABL investing, and so there are a number of other areas and ways to play this, but I would say that direct lending is becoming more and more mainstream and less of a premium there.
When I got to the board at a large university, I was shocked to see how much is allocated to private equity and private alternatives, broadly defined. Not the 10 to 15% that I grew up with. 40.
Yes.
And more.
And I've been in that seat. I've worked at an endowment.
And I'm like, so in 2022 comes along, 2023, I'm like, where are the marks down, kids?
Yeah.
Didn't get a mark down.
Yep.
It's such a scam, that private business. They don't mark. That's why I'm so shocked that they allocate so much to that. Are you surprised that universities have taken such an aggressive view of their portfolios as it relates to alternatives?
I'm not surprised. As I mentioned earlier, the return premium is there over public markets. You do need a chief investment officer mindset when you're allocating capital to private equity. So you don't want to lock up your capital in just any investment. You want to make sure that you're being paid to lock up your capital, and you can do that looking at public market equivalents or other measures. These universities and public pensions, for that matter, have pretty lofty return targets, and they need to get there. The thing to look at is how much of the operating budget is the institution supporting. Is it 30, 40, 50%? And if it is, then be really careful with your liquidity guardrails. And that's something that we do for our clients at NEPC. It's a number of simple but very powerful metrics to understand if we get out over our skis. And if we had those in place prior to 2008, a lot of heartache would have been avoided.
That's
really interesting. Hey, Sarah, really great stuff. Really appreciate you coming in. Sarah Samuels, we will definitely be seeing you soon, joining us from NEPC. Thank you so very much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.